Hello and welcome to another Smaulgld live stream. It is the 5th of September. It is Thursday evening 2019 and today's topic, why gold and silver got smashed today. We're going to go through some of the reasons. They were more particular to today than they are to macro trends, I believe, where gold and silver are heading, but we'll get into that. And also just a reminder, today we also did a midday Smaulgld live stream covering Alan Greenspan's recent comments that he thinks negative interest rates are coming to America. And also we covered Dudley's second op-ed challenging Donald Trump and suggesting that the Fed should indeed challenge the president and prevent him from executing his Chinese trade war. In other words, do not enable him to do so, because in the Fed's view, or at least Dudley's view, it would be a disaster, and the Fed's job is to actually to protect the president from himself. Quite an analysis from Dudley. We broke it all down earlier this afternoon. Let's get into why gold and silver got smashed today. We had some nice run-up in recent weeks in gold, and then silver started to play that catch-up. And then we saw the typical thing happen. Gold got smacked down and silver got smacked down even more. Let's take a look at the charts that I have prepared on this. So let's look at the gold price today. Here's the gold price, and boom, down goes Fraser, down 2.15%, down $33 in the aftermarket right now. It's at 15.18, and that's pretty much where it closed. So it has not recovered or continued its descent in the aftermarkets. Now, what is driving this? Well, let's first look at silver. You can see 2.15% decrease, down $33, and your silver price went down even more than double the percentage of gold. Typical, when gold rises, silver will not necessarily rise until gold rises for a long time. But the minute gold gets a hit, silver takes its hit immediately, and it went down nearly 5%, almost down $1, was down pretty much $1 at one point, over $1, and it closed down 93 cents, or down nearly 5%, 4.73%. Platinum also got hit, but about the same as gold, a little less. All right, so what caused all of this? Well, we have news again that maybe, or possibly, or definitely, China and the United States are going to meet to hash out their trade issues. Now, this has been something that's been going on for months, where the markets will react that there's going to be a trade breakthrough, or if they hear news that there's new tariffs being threatened or new tariffs being imposed, then the market sells off. The equity markets have been very sensitive to that. But let's take a look at the equity markets and the trend of the equity markets versus gold. Now, we revisit this chart a lot. This is the Dow Jones versus the spot gold. Well, you can see since 2018, all the equity markets have done, the Dow, since rising pretty much from, in a straight line, from 2016 up to 2018, they've been banging up against the top. You can see there, they've fallen below the top line. I've drawn a very rudimentary line across there for the Dow, but you can see 25,000, 26,000. It did drop at the end of last year, and it went back up. But you can see it has not managed to continue its upward trend for about a year and 9 months. Since 2018, since January 2018, it really has not moved ahead. So it's kind of bouncing along at the top. Meanwhile, take a look at gold. Since mid-2018, we pretty much are heading higher. And that is a significant trend. So what this tells me, and this is not investment advice or any type of actionable prediction, but what it does tell me is that the markets right now have topped. I mean, it's obvious they've topped out, and there is an appetite for risk assets, as we discussed the other day, but only if the environment is right. And the way the environment gets right is, well, they forget about valuations. But if there's breakthrough in the Chinese negotiations, well, then they might feel comfortable putting money back into stocks. But you've seen we've had a sell-off. We had a sell-off at the end of 2018, and we had a bit of a sell-off in the last month or so, but not that big of a deal. And today the markets came roaring back. The Dow Jones was up 372 points, NASDAQ up 139, S&P 500 up 38. All indexes are slightly off their highs, but still, Dow Jones up 1.4%, NASDAQ up 1.75%, and S&P 500 up 1.3%. And as we mentioned, gold and silver down well over 2% gold and almost 5% for silver. But here's an important point to consider. We're going to get to an important COMEX announcement in a second, but first let me cover the concept of what happened in the equity markets today against the backdrop of this. Maybe there's going to be a Chinese deal. One thing to keep in mind about the Chinese deal: the macro trend has nothing to do with the Chinese deal. U.S. companies aren't necessarily not having good earnings because of China. The markets are overvalued. The equity markets have very high PEs, very high price sales ratios, and they're just looking. It's almost as if fundamentals in those markets don't matter as much. They're almost a generic play if you have these negative interest rates and if you have an environment where do you put your money if you can't get a rate of return. It looks like the U.S. equity markets are relatively robust. It looks like after 2018 December, right after Christmas, that the United States, through the Exchange Stabilization Fund, the Plunge Protection Team, is willing to backstop the markets with the Powell put, the Trump put, and make sure that markets stay at a certain level. And we talked about today in the Smaulgld afternoon live stream, where Greenspan actually said, and he's not the first to say it, but he says that the stock market is an important component of the U.S. economy, and he gave a direct example. He said a 10% move in the S&P is worth 1% of GDP. So I think that Mnuchin and Trump's always trying to talk up the market. He realizes that while many people will say the market is not the economy, well, the market impacts the economy the way they measure it, and therefore it's very important to keep the markets where they want them to be. And also, the dollar they kind of wish would be a little lower because that would help with exports. Now, my point is this simply. A deal with China is not going to solve the world's no growth, high debt, and negative interest rate problem. It's going to nothing to do with it. All it might do is slow down China's increased subsidies and increased debt that it's taking on right now to keep the boat from capsizing. But that's not going to help China reduce its debt load. It may slow the pace of debt it's taking on. It's not going to solve the United States issue. It's not like all of a sudden the United States is going to be fiscally prudent and the unfunded liabilities are going to go away. And Christine Lagarde is going to change her view on being a highly accommodative ECB, and they're going to raise interest. None of that's going to happen. So today, to me, just indicates a trader's market. It indicates there's something to trade on. Maybe it's the algos, whatever it is. They hear Chinese news. They hear there might be a talk. They confirm the talks. And we don't even know if the talks will lead to anything. They could call off the talks. And, of course, that'll lead to some movement in the market on any particular day when they hear news about the talks being canceled, the talks being delayed, nothing coming out of the talks, some good news coming out of the talks. None of this is going to change, in my opinion, the trajectory of where these markets are headed. Now, where are the markets headed? Well, one thing is for sure, silver was on a tear. And I mentioned the other night, I said this time I don't think that the Fed, the Treasury, the United States would be interested in capping the price of gold and silver, because they actually, when they capped the price of gold and silver in 2012 and 13, they were concerned that the world was concerned that the Fed had gone overboard. They were done a series of QEs, and it looked like they were being very profligate and they wanted to shut it down. But now it seems to me that they want the noises out there, or they want the dollar to fall. So, in my opinion, they're less concerned about the price of gold and silver. However, it's not as simple an analysis as that, because they're also concerned about the price of equities. They want the price of equities to rise. So they're looking at not that gold and silver rising are a threat to the dollar, but gold and silver are a threat to take capital away from the equity market. So I think they're concerned about that. And I think today we might have seen, I have no way of knowing this, and even if this is a conspiracy theory, we do not know whether the government actually manipulates the price of gold and silver directly in these markets. We have evidence that JP Morgan has done it, but not necessarily for the purpose of suspending or curtailing price rises. We've got people admitting it. They're guilty. They've been cases on it where they've been spoofing. But that looks more like, instead of a systematic suppression of the price, more like they're just playing around and making money. It's still manipulation, but it may not be the manipulation that many of us think that's possible, that they try to repress the price of gold and silver. So we don't know what's going on, but it's possible. What's happening now is they're concerned that if gold and silver start to get a shine, then that indicates that equities are not the place to be. Look at my analysis. This is how I'm looking at things. Negative global interest rates mean increased demand for U.S. Treasuries. That's good. That's exactly where the U.S. wants to be. That's why I think they played it this way. When they finished QE, Stanley Fischer, vice chair of the Fed, convinced Mario Draghi, ECB, to do QE. Japan immediately, the next day when the Fed finished QE, they launched one. China's been going nuts, printing yuan and dollars and whatever else they can print. Debt is massive, and the United States stopped that monetization of debt, stopped QE, raised interest rates in order to get some distance between itself and other central banks and actually give the dollar, regain its standing where countries actually would realize, whether they like the dollar, whether they like the United States or not, that if you're going to hold reserves, you might as well hold reserves that actually pay a rate of interest, and that would be U.S. Treasuries. So these negative interest rates around the world, which I believe are orchestrated. I don't think there's this currency wars nonsense. I think all the central banks, the Western central banks, even China, they all work together to work out interest rate strategy and monetary policies. And this has put the United States dollar back on track, because there's still tremendous demand, despite what you hear about dumping treasuries and de-dollarization. The United States is still issuing massive amounts of T-bonds. The dollar is very, very strong as well. I know that's hard for a lot of people to understand, but it's all comparative. It's not strong against gold, and all other currencies are definitely not strong against gold. But in terms of actual nominal dollars moving in, the Treasury is still the largest and most liquid market in the world. Now, what the United States counts on is a strong-ish dollar, or at least strong demand for the dollar, not necessarily a high dollar index. And of course, they want those capital inflows into the stock market. And as I mentioned, that is going to be at some point, I don't want to use the overused cliche, unsustainable, but there is a limit to how far you can boost the stock market, how high the dollar can get before it causes damage to the United States and the rest of the world. But let's go back to the chart again. See, if you look at the Dow is bouncing along the top. So I think they realize that they really can't get. It wouldn't make sense for the Dow to start to take off from here, because I think investors might get cold feet. On a particular day, they may like to trade the Dow up like they did today, over 450 points at one point. But I think if the Dow were to take a 10-15% rise from here, you might get a lot of nervous Nellies, because it's already overvalued. A lot of the stocks in the S&P, a lot of stocks in the Dow are just not on traditional valuations worth that much. So I think what they're trying to do is to keep the stock market high and not have it collapse, but I don't think they're looking to boost it in the way that it went up between 2016 and 2018. It looks, you can see that line, it's basically gone nowhere. If you've been in stocks the last 2 years, you haven't really, unless you're doing stock picking, if you've just been in the indexes, you're pretty much flat to a little bit down. Whereas if you picked up gold, you are definitely up. All right, so let's go back now to the general thesis, which is it's unsustainable for the stock market to keep rising, and it's also unsustainable for U.S. Treasuries to have tremendous demand because, as Greenspan pointed out, if you get all this demand for Treasuries, it'll drive the yields down, and he's saying eventually they'll go negative. I'm not quite sure about that, but I think people will stop buying them if they actually go negative. But who knows? You know, the rest of the world is also, you got the $17 trillion worth of bonds out there. My point is negative interest rates in general can only, not on maybe on a day-to-day basis, can only be good for solid assets like gold, silver, and platinum, and to a lesser extent to speculative assets like Bitcoin, Litecoin, Ethereum, because while they are limited in issuance, they don't have the track record that gold and silver has. Although, as I mentioned last night, there are people and there are investors, and they do deploy capital, that believe at least Bitcoin is a store of value, whether you agree with that or not. And this is, again, where Smaulgld analysis differs from everyone else's. I put my own prejudice aside. If people think Bitcoin is worth something, it doesn't matter that you don't think that it is. If money flows towards Bitcoin, it flows there. So I have to take that into account in the analysis. And also, people deploy money towards cryptocurrencies on a speculative basis. But I do think that this current situation today was a trading day, and it doesn't reflect any change. However, there is a couple of other things happened today. One big thing over at the CME group. But let's look at this remember the inverted yield curve. Now, I had done, the ISM non-manufacturing was up today, and they didn't expect a strong reading because everyone's been talking about a U.S. recession. Well, we didn't have one the first quarter. We didn't have one the second quarter. The third quarter preliminary readings from the Atlanta Fed are still above water, not a negative growth. Remember, recession is 2 quarters of negative growth. And this whole thing about the inverted yield curve, that was a big story in December 2018. And I suppose part of that led to the decline in the stock market by the month's end. People have caught on to this idea that when the yield curve inverts, that historically, whatever the number is, the last recessions, I think in the next 6 to 24 months, you have a recession when that happens, when investors prefer the shorter dated bonds to the longer dated bonds, and they actually have a higher yield on the shorter date than the longer date, which is counterintuitive because the longer bond should pay a greater rate of interest. And the rationale why the markets might invert is that investors are uncertain about the future, and they say they're uncertain about the economy, and that's why they make those bets. My view is that all, quote, bets are off in a negative interest rate environment, and that perhaps the bond market is concerned about the markets, the bond markets and the equity markets, more than they are about the economy. And so I have not become an adherent to this theory. I don't care what the historical averages show, because I think the historical averages are a little too broad. So, for example, they say if it happens, the yield curve inverts between 6 and 24 months, you'll have a recession historically. Well, before the last 10 years, we always had a recession every 3 or 4 years. So at any given point, you can almost say if there's a full moon this month, which there is one every month, chances are between 6 and 24 months, we're going to have a recession. Well, how can you say that? Well, chances are there's a recession every 3 or 4 years, and chances are if there's a full moon within 6 to 24 months, you probably have a recession. Now, they're using this correlation, and I think it's different this time again because we have this negative interest rates. We have the stock market decoupled from the economy, and I think that 6 to 24 months, that doesn't mean much. So first of all, didn't happen in 6 months because they were yakking about this in December. It's not going to happen in 9 months. And it's not going to happen in a year. Why? In order for it to happen in a year, this current quarter would have to be negative, and so would the last quarter. And chances of this quarter being negative probably not going to happen, which would mean the earliest this thing could happen would be within 16 months. That would assume that we have a negative quarter in the fourth quarter and a negative quarter in the first quarter. Might not happen. Now, if it does happen in 2 years, I'm not impressed. I don't think that's I think that we're due for a recession. The only reason we haven't had a recession in the last 10 years is because of central bank intervention. In fact, if you listen today to the Smaulgld midday interview, Dudley's rationale for why he wants to oppose Trump and not enable him to engage in a trade war or to accelerate the trade war with China is because he wants to avoid a recession. It appears that the Fed has decided the last 10, 15 years that their job is not to allow there to be a business cycle, that their job is to avoid recessions. Now, if Trump wants a recession, as I pointed out earlier today, if he thinks that if the consequence of his battle with China is he can win the Chinese war by damaging them more, even if he damages the United States with a temporary recession, Dudley is saying our job is to prevent recessions. And that's not true historically. The Fed has viewed economic policy, monetary policy back in the 70s, that they needed to deepen the recession in order to eventually crush inflation and get out of the stagflation that they had in the late 70s. So, point being is that a recession is always around the corner. The yield curve in this instance I don't think means much because if the Fed, it sounds like, and Trump is in agreement, forget the Chinese portion, if they want to avoid a recession, they, quote, have the tools. They just intervene. They buy tons of stock, or they have some other central bank buy tons of stock. They drive rates down to zero. They drive rates even lower, and they can avoid a recession. It's not a healthy economy. It's an artificial economy. It's an economy based on central bank intervention. You can do tax cuts, but you can avoid a recession. So this whole idea that the yield curve is inverted and it means something, not in today's world it doesn't, because we don't have recessions, at least the way they measure them. They change how GDP is measured. They've changed the amount of intervention that they do in order to avoid recessions. So this whole yield curve just inverted, just another example of everyone jumping on the bag. Everybody wants there to be, that's the thing, the single, how do you say it? Single issue websites. Everything's about the collapse. They want to hear that. I mean, look, back in December, I did this one. Warning, head to the bunkers, the yield curve inverted. There was a lot of that back in December. There was a lot of the channels saying that, like they discovered something new, and this was it. And then when the stock price went down, they were all jumping up and down. Look at this. And then what happened? Intervention. Mnuchin and Trump, they all met and they boosted the market back up. And so I view this whole inverted yield curve as somewhat of a shmita. I don't think there's a lot to it. I think it's more the traders concerned about these markets, and they figure might as well have the short-term bond. I don't think they're not even thinking about the economy, because the economy doesn't drive the markets the way it used to. It's the other way around. Now, markets seem to drive the economy. Greenspan was saying that today. You get the stock market up, you get a GDP going up. Greenspan, Bernanke, Yellen have all talked about a wealth effect and how central bank policy can create that by rising stock prices, rising housing prices. And so I don't think that this yield curve thing is any big deal. But it does indicate today that what I believe happened was short-term trading based on Chinese optimism. But one other thing happened. And I don't know when it happened during the day, and it hasn't happened yet, but the CME group came out and said, effective tomorrow, you got to have another 19.5% margin put up for your silver positions. Well, that applies to if you're long silver and you're long on margin and you've got a pretty big position. Well, now what the CME group is saying, you got to add a little more to your account. Well, maybe they're not that bullish, and they also know that it's self-fulfilling, that if CME raises margin, they know that even if they want to hold on to the position and they have the cash to put up, they know that some of the people won't have the money or won't want to put up the money, and they'll close out their long position. Well, what happens then? Bingo, price goes down. This was the trick that they did back to the Hunts brother. Raise margin requirements, and then they went one step further, and they said all you can do is sell. But 19.5%, that's a big increase, and that happens tomorrow. So they either got to come up with the money, which means they might have sold today in order to come up with the money so they can put it in tomorrow, or they just sold because they realized they're not going to put the money up. They realize that other people are going to sell and put the money up, so they just might be closing out their position. I won't know all this till next week when we can see a better snapshot of the commitment of traders. Also, it could be that the CME group, I believe, has some type of connection to the government, and if they don't want gold and silver to catch attention and they want the equity markets to be leading the way, this is one way they can do it without even doing any short selling, without doing anything obvious. This creates, if you're just a rational trader, you're not out to manipulate and you want to make money, so this 19.5% margin in cutting it for me, I'm not going to do it. Now, this highlights the problem with trading on margin. I mean, then this actually is going to drive the price to a certain extent when who made the decision? COMEX, the CME group. Traders weren't, so they decide how much margin they're going to give, and if they decide how much margin they're going to give, then if they don't give enough, what happens? Well, now you've got an issue where you might have artificial selling. You might be able to cap a rally just by raising margins. I don't know if that was the intent. That may be that a lot of the prices had risen too fast. The way a CME group has a whole bunch of criteria, so they can always bury manipulation in their criteria by coming up with a whole bunch of other plausible rationales for why they added to the margin requirement. Alrighty then, well, let's see what y'all are saying in the comments, and then we're going to let you go, and we'll be back. I'm trying to do a couple, trying to get as many patrons as possible before maybe I shut this down, so I figure the more times I'm on, the more times that we might get more patrons, we might get new listeners who might be interested, but I don't see a long term on YouTube. We'll see how it goes, but let's take a look at the comment. Jeffrey Gotts, I haven't seen him in a while. Joe Smith, Nomadic Giant, Crypto Shrugged Author is here. He's in the Philippines. Wow. All is one now. Hello. All is one. Taylor Collins and Holloman Jack. A couple of weeks ago, there was a dude who sold all his silver for bought Litecoin because he was impatient waiting for silver to jump. Literally, the day he sold it jumped, kind of depressing. Yeah, that happens all the time, doesn't it? These people, they get fed up with one asset and they buy the other, and then that's the mark of the bottom for one and the start of a bull market for the other. Yeah. Ann is asking and requesting to hit the like button. Thank you. All right, Taylor Collins, my PM and royalty streaming equities were down as far as 7.5% today. Well, that's not good. Chris Gardner is here. What else do we have here? Tossing Molotov, silver to the moon. Tossing Molotov, silver is a metal you want during near apocalyptic conditions, otherwise gold is better. I do agree with that. There's a blog post I did, or a video, YouTube and BitChute called Smaulgld's Money Matrix. And silver got the highest scores for that. If the lights are out, silver is the best for that. Not gold, not Litecoin, not Bitcoin, because in your near apocalyptic environment, you're probably not going to have internet. You're probably not going to have electricity. And silver is probably the best barter item of all of the monies. All right, Taylor Collins. Let's see. What else do we have here? Jack. Tossing Molotovs. What else? I think that's it. You guys are talking to yourself, which is good. So I want to thank you all. And we're on the troll for patrons and Subscribe Star, Mug Stacker Club members, and all that information is on your screen. So please Support Smaulgld either by check, Smaulgld LLC, PO Box 714, Dover, New Hampshire 03820. Also, you got QR codes on the screen. You can donate Bitcoin and Litecoin. You can go to smaulgld.com, below this BitChute, below this YouTube, and you can buy your Smaulgld mugs or go to smaulgld.com. The other thing is people are starting to, it's a good sign, I suppose, for the retail market, buying from the Smaulgld links precious metals. You can buy through the links at SD Bullion, Golden Eagle Coin, and Money Metals Exchange. Those are what they call affiliate links. If you click on those, you go to the site. There's just a tracking code there. If you do buy, Smaulgld does make a small commission. You pay no more, no less than if you went there directly. And if you're going to shop there anyway, then please go ahead and do that. That does help the site out as well. All right. Now we're going to have some more news on gold and silver. Remember, Saturday Night Silver with Smaulgld and Solid Gold Sunday with Smaulgld. And I hope maybe tomorrow I can catch you up on what's going on with the primaries and Comey and so on. All right. Well, thank you very much, and keep Smaulgld in your donating plans. Thank you very much.